The Crypto Markets Update is brought to you by KuCoin, the best place to find the next crypto gem.
Well, if you've checked your balances just now, you'd see that some of your money is gone. And it's not because of a hack, but because the prices are down. And that's because of a jobs report that just came out. And joining us to discuss all this is none other than the legendary Marc Chandler, Managing Director and Chief Market Strategist at Bannockburn Global Forex. Welcome back, Marc.
Thanks. Always a pleasure to see you.
I was glad to have you on, especially on a day like today, because we had Nonfarm payrolls come out, and it was not as big of an increase as we've seen in other months. It seems to be the lowest since about a year ago. But the unemployment rate went from 3.7% to 3.5%, and the market is panicked. What do you think? What do you make of all this?
Yeah, no, you're right. I mean, I think in general, right, that the job growth is slowing. But if you look at pre-COVID levels, this kind of number that we saw today is still relatively strong. And most importantly, it's strong enough that the Federal Reserve is going to raise rates again next month. And the market says 75 basis points. And that's what the Fed has sort of been signaling. So I do think that's sort of baked in the mix now. And I think that broadly speaking, the next big thing, I mean, is going to be the CPI number next week. And there we'll probably see the headlines still soften because of energy, but the core rate may tick up. And just like we saw, to your point, the unemployment rate fell back to its cyclical low. We're likely to see the core rate of CPI go back up to its cyclical high. And so this just reinforces the idea of Fed tightening. And I'd say that the big thing that's happened since the data is that the market now is pushing. So the issue really, I should say, is where's the terminal rate going to be for Fed funds? How long are we going to have to take this pain? And the market right now is pushing from Q2 peak at 4.5% next year to a Q3 peak at about 4.75. And so that's weighing on risk assets broadly, stock market, as well as crypto.
So it seems like only yesterday, though, it was a few days ago, actually, everyone was smoking something and talking about a Fed pivot. And everyone was like, well, maybe the Fed will not get so aggressive anymore. Look at what the UK did. They all of a sudden rediscovered QE. And I'm looking at the map behind you. It shows Australia at the center of the world, which thankfully It's not. But nonetheless, they looked at how the Australians raised rates, and it was only 50 basis points. And they're saying, well, if the Aussies do it, and if the Brits do it, well, golly gee, maybe Powell will talk the rest of the Fed into doing it. But that was kind of a pipe dream, if you will. Is that correct?
Yes.
I mean, this was sort of like the market just losing its mind for 5 minutes. I have a theory that it's because most of the traders are of an age, they don't even remember pre-QE.
I don't know. I think it's more like this. I think that when the market does things that seem like illogical, I think it really is reflecting market psychology. The one thing that I think we can be confident of is tails do not wag the dog. Australia has moved to 25 basis points, 25 basis points rather than 50. Right. It did not signal anything for anybody, including New Zealand, who hiked rates the following day by 50 basis points. Surely the U.S. does not follow the RBA, but if anything, it'd probably be the other way around. And even then, I'd say that connection is pretty weak. I think that the Federal Reserve is taking its marching orders from CPI and the tight labor market, or what they perceive to be a tight labor market, to help fuel, to justify, and to give them confidence that the economy is strong enough to withstand tighter monetary policy.
Oh, tell that to Albanese.
Recently I saw numbers showing that Bitcoin had growing correlations with risk assets like the Nasdaq, S&P 500, but also a 90 correlation of risk-off assets such as treasuries and gold. So I wonder, what do you think? Where do you think Bitcoin is headed?
Yeah, so I tell you a couple of things. One is people have always sending me these charts of making these claims of how correlated crypto is to various macroeconomic variables. I was looking at something for somebody earlier this week that was trying to make a connection between Bitcoin and U.S. money supply. And what I think that a lot of people do, it's not just that that there's a generation of people who are trading money and who have access to capital. It's not just that they don't remember pre-QE days, but they might have even forgotten their math days. And the idea when you're doing these correlations, you can easily find two markets that look highly correlated because they're moving in the same direction. And I would say, one, you cannot really eyeball correlation. Secondly, the best kind of correlation, that is the most rigorous approach that we want in the markets as investors, is not so much the level of crypto, say level of Bitcoin, against the level of M2 or the level of the stock market. What we want is the change in crypto, the change in Bitcoin against the change in the stock market. And there I think that you'll find that that Bitcoin's correlation with the NASDAQ, it moves around, but it moves around at relatively high levels from about 0.4 to about 0.8. And that is on a 30-day rolling basis, looking at the percentage change of Bitcoin and the percentage change in the NASDAQ. Now, when I do look at the correlation with gold, and crypto is using gold as a proxy for risk-off assets, I find that the correlation is much less stable. It moves from positive correlation to a negative correlation. And right now, to your point, it is relatively high, a little bit more than 0.5. So that tells me Bitcoin more correlated to the stock market in a more stable fashion than with gold.
Mark, it's going to get. It's very difficult for you to. I'm sorry, but my head explodes when I hear 30-day correlations, because it's just I find it to be just too short of a time period to run a correlation. It's just it because of that volatility. I mean, like what is the, in your opinion, what would you say? I mean, would it 90-day? 180 days, 360?
I think it all depends upon your question. I think that, non-farm payrolls comes out every month. And so it does seem to be a monthly cycle of economic data. And if you're trying to figure out relationships, I think 30 days is the minimum. But to your point, it matters what kind of investors we think we are, what's our time frame. I talk to some people who are traders who like taking a position in the morning and getting it out at lunchtime is a long-term position. I think that there's a lot of people, a lot of people who read my work, who probably watch your shows as well, who trade intraday basis. And I'm afraid that a 100-day correlation or a 90-day correlation or a couple-year correlation, which as long-term investors we want to see, might be too long.